Well, Freddie Mac says the average rate on a 30-year fixed could climb to 6% by the end of 2010, if not sooner. This after hitting an all-time low in December. Are rates really ready to pop? And what will that do to the market? Well, here now is Lawrence Yun, Chief Economist and Senior VP of Research for the National Association of Realtors, and Matt Garrison, Managing Director at the Matt Garrison Group. Thank you to both of you for joining us today. Lawrence, let me start with you. If indeed rates do start to rise towards the 6% level, is this reflective of returning strength to the housing market, or is it more reflective of other factors such as the high cost of funding that banks are facing?
Well, no one should have expected that mortgage rate would remain under 5%. I mean, those are rock bottom rates. So the only way to move is up. So we do anticipate higher mortgage rates, which will be a negative for the housing market recovery, but there are some positives. The home buyer tax credit all the way to the middle of next year, and the job creation will begin to show up in the second half of next year. So there will be some neutralizing factor to rising rates.
Matt, net, do you think it's more negative or positive for the housing market?
Well, it's definitely not a positive if interest rates go up. It has an adverse effect on housing affordability. In terms of unemployment stabilizing or the picture getting a little better, I hope that Lawrence is right. Unfortunately, I'm not 100% sure he is. This is the same. The National Association of Realtors, I believe, last year predicted unemployment peaking at under 7%. So I hope they're right this time.
So would you imagine, therefore, Matt, that we're going to see a drop-off in housing sales as a result of those rising mortgage rates?
I think in terms of volume, I think that we're going to see a picture pretty equivalent with 2009. Maybe it'll get slightly better. Volume has to recover before prices can recover. I know NAR is predicting a 3.6% price increase for 2010. Again, I hope they're right. I think probably best case we're looking at flat to anemic growth, and worst case, I think personally that there may be another 5 to 10% downside.
Lawrence, am I right in thinking that you're a little bit more positive than that, and that you think that we could actually see in both values and also sales for homes some positive numbers for next year?
Well, the tax credit has been a huge stimulant to the housing market, so we saw a tremendous surge towards the November. I anticipate a second surge as the tax credit deadline looms in the middle of next year, and I believe at that time the inventory levels will have come down to about 6 months supply. I mean, that would be historical average and would be consistent with roughly 3 to 5%, a low single-digit price appreciation nationally. There would be a large local market variation. Some of the areas with trouble job market conditions, it will take longer to recover. But in some markets where we are now beginning to see multiple bidding beginning to show up, I mean, prices have already bottomed and are likely to rise, possibly even in the upper single digits.
Lawrence, what do you reckon, for example, an average fixed year 30-year is going to get to? I mean, Freddie Mac is saying possibly up to 6% by the end of 2010, maybe sooner. So timing a number, what are you looking at?
I have it at 5.7% towards the end of next year. So definitely rates should be rising. I anticipate it will be rising. Consumers need to take that into a consideration. And also for consumers, I think the one big lesson that we learned from the boom and bust period is to stay well within budget. Don't overstretch. Be comfortable. If they are emotionally and financially ready, then they should look into the home that is right size and well within their budget.
And Matt, so certainly if we're expecting mortgage rates to rise, Lawrence is saying, be prepared for it. What do you think the government can also do to prepare and perhaps also cushion a little bit the average mortgage rate holder?
Well, in terms of mortgage rates, I think the government's been doing everything they can to keep mortgage rates down. I think everyone knows that can't last forever. And that's reflected in Larry's prediction and in the Freddie Mac 6% prediction. In terms of stuff the government can do, the stimulus is great. We've attracted millions of millions of buyers into the market, mostly first-time buyers. I think some of that is probably cannibalizing people that would have bought later, and we gave them an incentive to buy now. I don't think that's necessarily a bad thing, but it's going to end in April, and the question is what happens when it ends with the increasing headwind of mortgage rates potentially increasing. One of the factors in the inventory, the 6-month inventory kind of stable number that Larry threw out is the pace of sales. And it can be at 6 months, with robust sales, as the tax credit comes to an end. And what happens if the sales volume goes down after that? We could be right back to 8, 9, 10 months.
Lawrence, do you have a response?
Well, I think the consumer confidence factor, once prices show consistent stabilization pattern, the consumer confidence related to home buying will be boosted. One of the factors that consumers have held back, and rationally so, was on the belief that prices could decline. So people are asking, why buy now when I can buy later? And that consumer pessimism, I believe, will no longer be at play in 2010. So people, I think they understand that home values have fallen, overcorrected, it is undervalued. So I think the consumer confidence related to home buying will improve, and hence that will be another booster aside from the job creation that I anticipate in 2010.
Yeah, psychology and confidence is always very important, isn't it? Thanks very much, Lawrence and Matt. Now, just to